the Chinese are going to win and the West is going to lose. The CCP is a criminal organization. I think the market has, for the past 2 years, in a very bizarre way, always underestimated where Jerome Powell will take rates and how long he'll keep them there.
Today we interviewed Doomberg, one of the authors of Doomberg, one of the most widely read finance newsletters on Substack. Welcome to the show, Doomberg.
Hey, great to be here. Looking forward to a great discussion.
So we're going to get to your outlook on commodities in a bit, but first, let's run through some headlines that came out this week. After pulling back for the most part in April, equities staged a rebound toward the end of the month. Early results from the reporting season suggest that over 80% of US companies are beating expectations. First quarter earnings are now on track to increase by 4.7% from a year ago. Now, on Tuesday, so today, as of recording, we have the Eurozone CPI GDP. We also have Amazon, Samsung, HSBC earnings reporting. Tomorrow, Wednesday, the Federal Reserve rate decision that we're all looking forward to, and Apple earnings on Thursday. So, Doomberg, if we look at the short term, what are you watching this week?
Yeah, I'm always keeping an eye on commodity prices, of course, because we believe these are critical inputs into anybody's macroeconomic outlook. I think if we scan the globe, the U.S. is still doing pretty well, although the GDP print came in below expectations. So we'll see what the revisions look like there. I think Europe is still sputtering a little bit by comparison. The data out of China is always difficult to interpret, and about the only thing you could trust is export data going into China. Everything else is a bit of a black box to Western analysts. But on balance, I think the U.S. economy in particular is doing fine. It's hard to struggle when you have the greatest abundance of cheap hydrocarbons the world has ever known, and a fiscally stimulative Congress, and a Fed that's ready to support the incumbent party heading into a critical election. And so we don't see major economic challenges on the horizon. What the Fed will do will be, of course, very interesting, but it doesn't surprise us that especially the U.S.-based companies are doing pretty well with natural gas trading for as low as it is, and that molecule's critical role in our overall economic performance. And so I think it's about as expected for us going into the year based on the way commodities were trading.
Now, you talked about a broad set of things there. I want to zoom in on a couple of those. And first, let's start with oil, which now, on the short term, it fell as signs of progress toward a ceasefire between Israel and Hamas reduced crude's geopolitical risk premium. WTI fell as much as 1.6% on Monday after the New York Times reported that Israel is open to a truce involving an initial release of 33 hostages, fewer than it previously thought. Now, we received a, to be honest, slightly convoluted audience question. I want to read it here. How do the engagements of major oil-producing nations in current global conflicts influence the pricing trends of oil and natural gas? Additionally, do principles of overextended markets and auction market theory hold relevance in such geopolitical scenarios? And if so, at what juncture within the market cycle? So I guess, in other words, at this point, what influences the oil price? If not physical supply-demand dynamics, is it only geopolitical risk?
I think as we look across the world, oil is the one outlier amongst the primary energy feedstocks for its current pricing compared to the others. So, for example, coal back down to $130 a ton, at least Newcastle coal out of Australia, and LNG, natural gas, at $9 to $10 per million BTU, depending on which contract you look at. And of course, natural gas in the U.S., where we have a serious glut because it is a co-product of oil production, is trading around $2 per million BTU, which is the oil equivalent price of, say, $12. Oil trading, in the low 80s for WTI, and Brent a few bucks higher. To us, has to be about geopolitical risk. There is some switching ability between these primary sources of energy that is not embodied in the oil price today. And in fact, one of our metrics to try to get a proxy for geopolitical risk is to multiply the price of landed LNG in Europe by 5.6 and see what that tells you the price of oil, should be, all things being equal, because they're relatively they're not fully substitutable products, but there is enough crossover that typically these types of arbitrages should close. So we do view also, we watch with great interest the price action in oil and gold and Bitcoin on the infamous Friday, April 12th, when it looked like Iran was going to be launching several hundred missiles and drones into Israel, and the prospect of a unintended escalatory spiral seemed likely. And we saw oil spike higher and gold spike higher until they came crashing down when Iran famously said the strike was over while the missiles were still in the air, which gave the market the impression that some of this may have been theatrical. And then Bitcoin, interestingly, traded in the opposite direction to gold. It crashed on the news of the missiles being launched and then began to recover after the market decided that this was more theater than war. And so the action in oil, swinging $10 basically as a proxy for the risk of escalation in the Middle East, I think is further strong evidence that because of the choke points of the shipping lanes and the vast amount of oil that is produced in the Middle East, and by Iran, for example, there has to be a substantial geopolitical risk premium embedded in oil. And we have said, both in some of our writing and on other podcast appearances, that if peace were to break out by some miracle in both Europe and the Middle East, we suspect oil would be trading below $50 relatively quickly.
So the geopolitical risk premium embedded right now is what, around $30 or?
Yeah, if I had to guess. So if I look at LNG, landed LNG times 6, that's $54 a barrel oil, basically, and oil trading at 81. So to me, that's probably about right, $20 to $30. Of course, not all of that difference is geopolitical risk, but that puts a ceiling on it at least. It's not more than that, but it's probably around $20 to $25 a barrel. The global primary energy market is either relatively well supplied or in a glut situation, with natural gas in North America, which is a huge market, of course. On balance, the world is well supplied with primary energy today, and there's no real justification for oil trading in the $80 a barrel range, given how much slack capacity OPEC has, for example, that it could bring back to market and so on.
Now, on December 22nd, 2023, you published an article in your premium newsletter that was titled "Peak Cheap Oil is a Myth." Can you summarize the key points of this article for our audience?
Yeah, the number one thing, there's this crowd of people who believe that we're on the cusp of having less oil than we've ever had, and we'll have less economically accessible oil into the future, and this, as a consequence, is going to cause the price of oil to skyrocket and the economy to collapse and the whole system to come tumbling down. We've never believed in that for the following reason. One, that is a giant short bet on human ingenuity, and humans are very creative, especially when it comes to generating primary energy, because energy is life and every human everywhere wants more of it. The vast majority of the constraints towards continuing to grow our primary energy are political. They are not geological. In the U.S., for example, there's a massive shale play in California that's basically off limits. Some wonder whether that wouldn't be among the more prolific shale regions in the U.S., but it's just off limits. It's in California. California is extremely progressive when it comes to environmental regulation. These are political choices. So the very things that the peak cheap oil crowd fears, i.e., the Permian Basin rolling over, which it inevitably will, the price in the spike of oil that results will be the political pressure that removes the likes of Gavin Newsom and Joe Biden from office, and they will be replaced with people who will be pro-industry and for the development of primary energy. The lack of nuclear power in the world is a deeply political choice, as is its cost, because it didn't used to be this expensive to build nuclear power. We've decided to make it so for political reasons. Venezuela is on its back foot. Mexico is on its back foot. There's huge deposits in Argentina, Russia. Russia has an enormous reservoir of hydrocarbons it could be exploiting. OPEC has excess production that's sitting on the sidelines. The very spike in energy costs that would result from a temporary disruption of supply or a decrease in growth will cause the market to correct it. And then on top of all of that, We have so much natural gas in the world, we don't know what to do with it. And ultimately, oil is burned in engines to do work. We'll just change the engines and we'll burn natural gas instead. And it doesn't take much in the way of substitution to put a cap on prices. We saw this when Biden emptied the strategic petroleum reserves to the tune of 1 million barrels a day for 6 months. That was the equivalent of 1% supply for 6 months, or 0.5% of a year's supply poured onto the market. The price of oil was cut in half. Well, it doesn't take much in the way of incremental supply to make up for whatever the Permian Basin doesn't show up with. It might take some time. Oil could spike to $150 or $200. That would not be proof of peak cheap oil. That would be proof of dumb politics, which would get wiped away. We have way more than enough oil and natural gas liquids and natural gas and coal to last us a century and beyond. And if we're still burning hydrocarbons a century from now, shame on us, because we should just be building nuclear reactors anyway. So there's people who like to conflate the natural oscillations of the commodity cycle and draw tangent lines to sine curves, especially when shortages are arising. And it must be profitable to say and write such things, I suppose. But in our view, one need not conflate a temporary crisis with a permanent structural shift in the economy.
Interesting. Now, let's be a bit educational here. We also try to always have a couple of educational segments in these kind of conversations. So you talked about the price of oil and we talked about the geopolitical risk premium. When the price of oil is in that price range, around 80 where it's trading right now, you also mentioned OPEC. Who's profiting, who's benefiting, and why? Tell us a bit about the power dynamics at play here.
If you look across OPEC, they would like the price of oil to range between $70 and $90 a barrel, because in their view, that is the sweet spot. They can make a comfortable profit, but the price of oil does not disrupt economic growth. I mean, we all know that when oil spikes, one of the ways the market corrects itself is it destroys demand, which leads to economic contraction and recessions until new supply can be brought online, which it inevitably is. And so in the Goldilocks world, OPEC is trying to manage the price of oil to be within that range. They might enjoy a spike in oil and the revenues that it brings, but they know it's not sustainable. And don't forget, at $80 oil, using Bloomberg's inflation index, that's the equivalent of $25 a barrel oil in 1980s money. Like, oil is still very, very cheap at $80 a barrel. It was in the 20s during the 1980s. It's still in the 20s, correcting for inflation. Like, the market figures out a way to meet demand with supply, and it will again into the future. And so, perhaps the equilibrium Goldilocks price of oil will go up with inflation. We are still having significant inflationary pulses, and in no small part because of the ongoing wars and the Black Sea and shipping lanes in the Middle East and so on. And so those things will work themselves out. So perhaps the equivalent price of oil in 2 or 3 years will be $100 a barrel, because that will be roughly $25 in 1980s money. Another way to look at the price of oil is how many ounces of gold it takes to buy it. And the gold to oil ratio tells you that we have plenty of oil and a depreciating fiat currency used to transact it. And so that's the equilibrium price today. And then if you just sort of apply an inflation marker to that. Now, OPEC might not be able to keep the price in the $70 and $90 range. It could go below $70 too. Again, I think if peace were to break out and the shipping lanes would be declogged and Russian commodities were welcomed back onto the market and Iranian oil was welcomed back onto the market, and China has a breakthrough in shale production and Argentina develops its massive shale field, and Venezuela is welcomed back into the fold, and we work out something with Guyana and their impressive deposits. Like, there's plenty of oil. We have very good contacts in the commodity sector. I was speaking to a senior executive at a major multinational oil company a few weeks ago, and he told me, Doom, if we need to find it, we know where to get it. It's not going to be that hard.
That's interesting. On another note, Warren Buffett, he continues to add to his oil positions too, right? Occidental Petroleum, Chevron. What is someone like him seeing in oil?
Well, what Warren Buffett does is a function of what Warren Buffett needs to do. And one of the things he needs to do is to make large investments in the companies that he participates in, because he has a lot of money to put to work. And so many of the investment options that you or I or other, retail investors might consider are kind of off limits to him, because there's just not enough liquidity in the name for him to participate in. So when he likes an industry or he likes a company, he tends to buy a lot of it, as we saw what he did with Apple and Coca-Cola all those years ago and so on. And so he's probably bullish energy long-term, sees that the price of oil is relatively cheap on an inflation-adjusted basis. And as a hedge against, geopolitical risk and economic disruption, owning some oil is probably good for his portfolio and gives him a bit of alpha. So that doesn't surprise me. And he gets to know the companies quite well that he invests in, as all investors should. And it doesn't surprise me that once he's decided to buy a company, he adds to the stake every once in a while and manages it carefully.
Yeah, you mentioned OPEC a couple of times now, and we can't treat OPEC as just a block, right? It's there's multiple players in there, and they probably have different agendas. So can you tell us a little bit more about that?
Sure. I think the unity amongst OPEC is pretty good right now compared to historical, but I will say, studying the intricacies of the various participants in the OPEC cartel is not something we've spent an enormous amount of time embarking upon. But at the same time, they have been pretty disciplined about keeping excess production offline in the past couple of years to manage the price upwards to this $80 range that we find ourselves in. If you look at like the 2-year chart of oil, it's pretty remarkable. It's just like a little oscillating sine wave between these values. And so I think, and by the way, the shale patch would like that price too, right? And so I think, we have long argued, of course, the way to defeat Putin and the way to rob his war machine of the funds it needs to execute his objectives is to flood the world with hydrocarbons, drive the price of oil down as low as we can, and cut his revenue. The whole sanctions policy of targeting volume is insane, and anybody who's spent 5 minutes in industry should know better. And clearly there's not many of those in the Biden administration or amongst the European leaders who are the architects of this sanctions policy that was always going to fail and in fact backfire on the West. We have said the U.S. Navy should be escorting every Russian cargo ship and tanker full of oil to the market, because we want every drop of oil to get to the market as possible to crash the price and rob Putin of his revenue that way. And so OPEC has done pretty well, all things considered. And so I that's the ultimate judge, is has the price of oil stayed within a range that they find ideal? And the answer in the past several months is yes.
We have another audience question, and we're going to show it on screen, but I'll rephrase it. Essentially, what price movement can we expect? Is this the top? Is this the upper end of the price range? Give us your informed speculation.
I would say that in the commodity world, because of the price elasticity of demand, any moment we are subject to the unintended consequences of a geopolitical explosion. And so I hesitate to say we're at the top, because you don't know whether these proxy wars that the U.S. is funding will go awry, whether the Ukrainians, for example, who are on their back foot militarily, I think that's no longer a controversial thing to say. If they decide to swarm as much of Russia's oil production as possible with drones, despite the protests of the Biden administration, oil could go above 120, 130, 140 in a day. And so the danger in playing commodities and trading commodities directly is that they are subject to massive swings in price as a function of geopolitical events. Now, there's lots of money to be made in those moments if you have the courage and the bankroll to take the opposite end of a trade like that, because ultimately these commodities regress down to their mean. But the volatility in time of war, especially we have a proxy war between two nuclear superpowers. We have significant tension between the U.S. and China. We watched with great interest Secretary Blinken's visit to China last week, and how it was reported here versus how it was reported in China. And of course, the Middle East is a tinderbox waiting to explode. And so right now, as we see here today, gold is back below or around $2,300 an ounce. And oil is down a few bucks. There must be some headlines about truce, perhaps, as you were referring to, or or some other development that is calming the markets. But you could wake up overnight if a terrorist group fires the wrong missile at the right place. You could see plus $20 overnight in oil. We're not calling that. The base case is hopefully peace. It's certainly what we would want, and what everybody should be hoping for. War is the ultimate failure of diplomacy. But as it stands now, coal and natural gas are telling us that the markets are well supplied. Oil has a significant geopolitical risk premium, and it reacts to the headlines. The oil is not reacting to inventory levels and refinery run rates and the typical things that it would respond to when there's no geopolitical tensions and the economy is humming along. Oil is moving on headlines about war. That's what's driving the price of oil today. And so if you think war is not going to happen, that Israel is not going to continue its military conflict in the Gaza Strip, and Iran and Israel are done exchanging missiles, then fine. Yes, I mean we would be seeing a top. But if you don't have such a view, or you don't have conviction in that view, then I would hesitate to say that we've seen the worst of the price action in oil.
What could be an oil price that triggers a recession?
Well, I mean, it's not just the price, it's the volatility, of course. So if it spikes $20, $30, $40, $50, then that leads to other panic. Biden would, of course, respond. We're in an election year in the U.S., and Biden is hyper aware of the impact of the national price of gasoline on his reelection chances and tries to manage it accordingly. It's fascinating for us to see that his new climate czar, John Podesta, is out talking about how they might be putting more oil out of the SPR into the markets ahead of the election. I mean, this is, of course, going to increase demand for oil and cause more carbon emissions. So it's weird to see the climate czar talking about the micromanagement of gasoline prices in the U.S., but such is the importance of that metric to Joe Biden in particular, who has that seared in his brain from his multiple decades as a senator from Delaware. And so, it's if oil goes to 150, we're going to risk a recession. And if oil stays around here or drops a little bit, then that's going to be, all things equal, moderately bullish for economic activity.
Switching gears, we talked about Buffett earlier. Let's move to another much-discussed billionaire on this channel, and that's Bill Ackman. And Bill Ackman also has a hedge against higher energy prices currently. We read his Pershing Square Holdings annual report, and he says there, we also continue to maintain our energy-related hedge to mitigate the impact of a large rise in energy prices. As energy prices decreased in 2023, the hedge's value declined to about 39% below cost at year end and has increased in value since the beginning of the year with a rise in energy prices. Help us contextualize what Bill Ackman and maybe other players that you are aware of are doing here.
I think they're engaging in a form of acquisition of insurance. So he used the word hedge. Generally speaking, when you pay for insurance, you don't hope to cash in on it because it means something else has gone bad. So I pay for home insurance every year, and I don't begrudge those premiums when December 31st rolls around and my house has not yet burned down. Now, Bill Ackman famously made an enormous amount of money on a hedge during the COVID affair. And so the fact that he is hedged against energy now might be getting more publicity and more meaning may be read into it because of the sort of survivorship bias of his one of the greatest trades ever on paper, his hedges against the impact of the COVID pandemic and the impact it would have on the economy and stocks and so on. And so I don't ascribe too much weight to the fact that Bill Ackman has prudently hedged some of his other exposure with some deep out-of-the-money call options on some weird oil futures contract probably. That's probably not super relevant for most retail investors.
Now, this ties in very nicely with an audience question that might lead to an interesting discussion. So it's a very long question. I'll try to make it a bit shorter, but essentially he's asking, what does he, so Doomberg, think about this investment thesis? Long countries with cheap and reliable energy, short those without. And now, one example this person gives is US versus China. So China imports about 20,000 petajoule of energy every year, which is up from nothing 25 years ago. apparently equivalent of 9 million barrels per day. And the USA, in contrast to that, have entirely closed their primary energy deficit from 30 quadrillion BTU to zero. Now, from an energy perspective, again, reading the question, the economic boom in China over the past 2 to 3 decades has been funded by the US. Their appetite for energy from abroad has been satisfied by an increase in US energy output. So, long US, short China. What do you think about this broad investment hypothesis?
We have a slightly more nuanced analysis that we consider. We always tell ourselves that the most important question a geopolitical analyst can answer is, are the energy markets short or long or balanced? And during times of relative energy abundance, the difference between commodity producers and commodity importers is relatively minor. And those economies that add significant value to primary energy, i.e. manufacturing and so on, like Germany, for example, tend to do quite well by comparison. During times of energy shortages is where the differences between importing and exporting nations become apparent. And we saw that with the currency moves that occurred during the European energy crisis that spread globally. Those countries that were back integrated to energy or net energy exporters, their currencies did quite well to the extent that they were freely floating. And countries that were importing energy like the euro and the British pound and the yen, they all tended to perform negatively, all things being equal. And so right now, absent the geopolitical risk, I would say that the going long energy importers going long energy exporters and short energy importers wouldn't necessarily make the most amount of sense because there's no urgency. When energy is well supplied, it is and can be treated like any other commodity, but when it is short, it cannot. And so that's why the most important question we always ask ourselves is, what is the state of the physical energy markets in the world? What's coal trading for? What's natural gas trading for in the various regions? What's oil trading for? What explains those differences and so on? And right now, other than the risk premium, the markets are pretty well supplied.
Now, does this trade make sense on a multi-decade basis?
Yeah, I mean, well, first of all, we're not traders, and nobody can hold a position for multiple decades except for maybe Warren Buffett, and so it's not something we've given a lot of thought to. I'd say all things being equal, as a country, you would want to be a net energy exporter for sure. You would want to have domestic control over your own supply so that if something happened in the rest of the world, your companies can be continuously supplied with the necessary energy they need to add value through manufacturing and home heating and all the other things that we do with primary energy, growing your own food. So, I mean, the U.S. is very well supplied across multiple dimensions, and in the long term, we're deeply bullish to the U.S. as soon as we clear up our political problems here, hopefully soon, and our fiscal situation, of course. But even if we had a, quote, great reset, you'd want to be in the U.S. We have enormous amounts of food and fertilizer and chemicals and auto manufacturing and oil and natural gas and coal and nuclear. We have great institutions and deep ports and an amazing river system. And there's a lot going on, and our neighbors are friendly and peaceful. And Canada has an enormous amount of natural resources, as does Mexico. We have so many of our resources off limits for exploitation. We can't drill in much of the Gulf of Mexico, along the Atlantic or Pacific coast. Alaska is off limits. Like, all these are political choices that in a big enough crisis we would undo, and that would just be adding on top of the miraculous amount of energy that we have in North America today. And so, sure, I mean, long term, I would be bullish the U.S., I would be bullish Canada, I would be bullish Australia, I'd be bullish Russia, I'd be bullish the Middle East. There's a reason why when you go to Saudi Arabia, all the sidewalks are paved in gold. I mean, they have an enormous amount of energy, and they export it to the world at a great price. This is not complicated. And there's also a reason why Germany is deindustrializing it, shot itself in the foot with its energy strategy. So long term, I'd rather not be in a country that can't get its energy act together, and I would rather be in a country. And so if that's the basis of a trade, of a long-term set it and forget it allocation of your portfolio, sure, I think that's wise enough.
Yeah, perfect. Back to Ackman, he also wrote a mildly funny tweet about Bitcoin going to infinity due to increased energy use. Let's talk about Bitcoin for a bit. How are you looking at Bitcoin now that we have ETFs in the US? We have SEC classifying it as a commodity. What are your views on Bitcoin?
I don't have very strongly held views on Bitcoin. I've never owned any Bitcoin. Um, I understand why people are attracted to Bitcoin. I understand why people hold it. I even understand and enjoy observing the various Bitcoin maxis and their behavior as much as as funny as it can be. Sometimes we've written relatively favorably about, for example, how Bitcoin mining could help peaker plants and help shave off some of the intermittency that comes with the forced introduction of wind and solar. That'll never happen in the U.S. at any scale, of course, because environmentalists will oppose it. We don't have strong views. We prefer to hedge the existential threat of the fiscal and financial situation of the West by owning gold and owning shares in companies that are privately held that we could understand and that we can know and that we could help directly, and owning things like land and collectibles and so on. But much like Bitcoin, gold is the asset that we own that we don't necessarily love when it goes up a lot, because that's signaling other problems in the world, right? And so I think Bitcoin is the same way. Now, Bitcoin is what it is. It is, by definition, it's like gold. It doesn't produce any dividends. And so it trades basically at the margin. And could it go to infinity? Sure. Could it go back to zero? Sure. I have many friends who own Bitcoin. If it goes to $1 million a coin, I'd be more than happy for them. Congratulations.
You mentioned land and collectibles there. So that has a place in every investor's portfolio, or what are you thinking about it?
Our strategy is threefold. We earn money in fiat. We pay our taxes in fiat. We participate in the Western fiat dollar-based system because this is where we live. We save money by buying real assets like land and collectibles and gold. And then we invest privately where we can impact the outcome directly and create sweat alpha of our own doing. We don't really trade in the stock markets, which is why your question earlier about whether this such and such would be a good trade. The only real thing that we own in size that trades in stock markets is like the Sprott physical gold trusts, which is how we like to park our liquidity as we are entering and exiting various private investments or accumulating some profit by the successful operation of our business. But otherwise, we're sort of market observers as opposed to participants.
Okay. And then maybe let's talk about that for a second. Land and collectibles, for a newcomer to those markets, what are opportunities you see in the US right now? How do you suggest someone approaches these markets?
So with respect to collectibles, you need to develop an expertise over years to understand what's truly valuable and what will be prized in the future. So whether it's collectible cars or watches or the typical things that people collect, art, for example, I would say you need to do a lot of studying. And normally you begin to study these things when you're young and you don't have all that much incremental savings to deploy. But then by the time you get to the peak earning phases of your life, you will have developed enough of an expertise. Invest in what you know is the number one thing, and same thing with land. So, the old adage that location. Most of our land is purchased in a small radius around where we live because we have our fingers on the pulse of local development dynamics. And this city is moving to the north, and so buying that tract of farmland just north of the current subdivisions is probably going to be a wise investment. Or boy, this city is, has lost its major source of economic prosperity. A major factory is shut down. You probably don't want to invest in that city right now. Or maybe you do because you think somebody big will come in and the prices are depressed. And so invest in what you know. We don't do so with any leverage. We're very prudent in that regard. But if you are comfortable with it, that's an easy trade. Like for example, I enjoy the collectible watch market. I think I have a pretty good pulse on the trends in that regard. And as prices come back, maybe you'll buy a certain model, and then as prices get a little frothy, maybe you'll let a few pieces go. Or if you just want to hold it and put it in a safe for 50 years, that's fine too. Same with gold. We just sort of we view gold as 20 ounces of gold, 20 American Eagles will buy you a mid-size SUV today. And I think in 20 years, it'll still buy you a mid-size SUV. And so we're not in gold to make money. We're in gold to preserve our purchasing power and have a bit of liquidity during a time of an emergency.
Perfect. Now, inflation, it came in a little hotter than expected. Is inflation making a comeback? Do we have any risk of stagflation? What are your views there?
I think inflation is persistent in large part because of the supply chain issues that we talked about and the need for the Western world to onshore and friendshore supply chains out of China. If we're going to go into conflict with China and start sanctioning them, and they're going to do a tit for tat, they have a lot of leverage over us economically. And the scramble to hedge against that is going to be passed on to consumers. And I think that explains in part the persistent nature of inflation that the Fed is struggling so hard to bring back in line.
Federal Reserve rate decision is going to be on Wednesday, so tomorrow as of this recording. What are your expectations?
If I could read the Fed, I wouldn't be writing on Substack. I'd be trading exotic interest rate futures. But I don't think they're going to make any major moves. The one thing about Jerome Powell that few could argue is he signals to the market his intent. The weird part is the market never quite seems to believe him. So I think if he was going to make a major change in policy, he would have flagged it by now. So I think more of the same. The election is still far away. The political pressure is low. And so I suspect the market will be underwhelmed by any change in policy if they're looking for one.
So you believe there's going to be any rate cuts this year, or it's not happening?
I think the market has, for the past 2 years, in a very bizarre way, always underestimated where Jerome Powell will take rates and how long he'll keep them there. And I think if you continue with that trend, then absent a crisis, Jerome Powell would like to keep rates where they are. So something would have to change, either politically or militarily, or the economic data would have to come in a little colder than what we think is probably going to happen for him to make a material change. And so if you pushed me, we would not be in the we're going to cut rates substantially camp, and that we would be in the higher for longer camp, because that's what Jerome Powell is saying. And betting against what Jerome Powell is telling you he's going to do has been a bad bet in the past 2 years. And so until he tells us anything different, I think it's just take him at his word.
Where is the recession, by the way? We have all kinds of indicators like the inverse yield curve telling us, like, inverted for a record 600 plus days by now, telling us it's time for a recession. It's not happening.
Yeah, we wrote a piece earlier this year called Slick Landing, where we tried to argue that at least in the U.S., the giant abundance of cheap, clean hydrocarbons, relatively, combined with a highly fiscally irresponsible Congress, are not the ingredients that make for a recession in the short term. Now, the fiscal spending in particular is just pushing crisis down the road, of course. But all things being equal, the U.S. produces 30% of the world's natural gas, and it's trading at the energy equivalent price of $12 a barrel oil. And we use natural gas to make fertilizer and chemicals and heat homes and cook and do all manner of important things. And having one of the world's cleanest hydrocarbons, well, the world's cleanest hydrocarbon, really, trading for pennies on the dollar, available in ample supply, is a tailwind. And what amazes me is when we observe other macro economists building models and making predictions, almost nobody talks about the energy markets as an input into their model. We all know if oil goes to $200 a barrel, we're going to see recession. And we have observed how screwing up your energy policy is bearish for German GDP through no action of Biden's. The U.S. is an energy superpower because it has two unique aspects. One, mineral rights are owned by landowners, and two, much of the U.S. regulatory policy is regulated at the state level. And so because of those two reasons, Oklahoma and Texas and Louisiana and so on have massive supplies of energy being brought to the market, and California is doing none. And so, when you have, 20% of the world's oil and other petroleum liquids being produced here, we have more refining capacity than we need to supply our domestic markets. We're a net exporter of refined products. And when we have ample supplies of coal and the world's cheapest natural gas, combined with fiscal stimulus, and in fact, higher interest rates are a form of fiscal stimulus because the interest payments to people with money market funds and so on are kind of stimmies for rich people, to quote our friend Luke Roman. And so, by and large, I think if you're looking for a reason why hiking rates from 0 to 5% didn't crash the economy, I think you should look no further than the performance of the U.S. energy companies.
Now, you mentioned Germany a couple of times, and I think both of us share the view that energy prices are the ability to generate cheap energy is one of the most important inputs for economies, and like judging the German economy by that, like we don't see, we're not very optimistic. But another thing that Germany does or has done pretty well in the past is producing cars. Now, Mercedes CEO said in February 2024 during an interview with a German newspaper called Zeit that gas-powered cars are far from done and they'll be available in the 2030s too. What other interesting trends are you observing in regards to electric-powered vehicles? Has there been too much enthusiasm around that?
So as we were getting ready to record, we published our latest piece, which you would not have had time to read because literally it was 1 minute before I signed on, called Chip Shot, where we talked about China's efforts in the semiconductor space, and we used as an example what it has done to electric vehicles. And we are making a pretty significant call in that piece, and I could read a bit to you if you're interested. The Chinese have come to dominate electric vehicles and the supply chains to an extent that nobody in the West has really internalized. And in this piece, we say, quote, if history is any guide, Western automakers, all of them, no matter their current presence in China, are in for a world of hurt. Japan, Europe, and the U.S. may throw up trade barriers to protect national brands, but the rest of the world will happily welcome radically superior cars at a fraction of what they are used to paying. And the likes of Toyota, Volkswagen, GM, Ford, and Tesla are capitalized for global growth. China is rolling out $10,000 electric vehicles that have 200 miles of range. The Western automakers have lost the war. And we've seen this. We lay out the exact strategy of China in that piece. I recommend everybody listening go to Doomberg.com and read it. China is going to do that in semiconductors, which is the point of the piece. But the automakers in the West are in for a world of hurt. BYD and other Chinese brands produce beautiful cars at a fraction of what people thought was impossibly cheap. Ford can't compete with that. GM can't compete with that. And the global South will welcome those exports. I mean, we could put trade barriers to stop China from importing to the U.S., and Europe can do the same. But Volkswagen and Toyota and GM and Ford sell all over the world, and they're going to get their clocks cleaned by the Chinese. That's coming. And we've seen it. I've been in the solar industry when China decided it wanted to own it, and it put everybody in the West out of business in a matter of a decade. It's the same playbook. And they've done it with electric vehicles. They're so far ahead of the rest of the world. The analysts can't internalize it, and we try to in this piece.
So are electric cars going to have, is that going to help electric cars gain mass adoption, become the most viable option, or are we going to see alternatives like compressed natural gas?
Take BYD. They have an amazing array of beautifully constructed, really efficient and dirt cheap hybrid electric cars, plug-in hybrids, where you get 30, 40, 50 miles of range and you have an internal combustion engine as backup and you no longer have range anxiety. We think the platform that will win in the long term is plug-in hybrids. I think BEVs don't make much sense, especially in a world where battery materials are rate limiting or constraining. You have to manage to those constraints, and the gasoline abated per kilogram of battery materials is far superior for a soft hybrid or a plug-in hybrid than a BEV. And BYD, unlike the other electric pure, like Tesla, for example, only makes electric vehicles, BYD sells as many plug-ins or even more than they do BEVs. And in China, it's not BEVs that are prioritized, it's, quote, new energy vehicles. And plug-in materials, in fact, are getting ever more favorable treatment by the Chinese government. And so I think that's going to be the main winner. And if it is, the Chinese will still dominate because they were making these incredible cars. And I remember being in the industry when I saw the first BYD Frankenstein mobile back in the late 2000s. And it was a ripped off Corolla. It looked exactly like a Corolla with a bunch of other automakers' intellectual property embedded in it. And now they are a dominant force. I mean, they are going to win and the West is going to lose. When the CCP dedicates the entirety of its resources to accomplish an industrial goal to feed its geopolitical strength, it wins. And where it's too slow. And they're going to win in semiconductors too, which has huge geopolitical consequences beyond the automotive sector.
So in the end, capitalism kind of still works because the consumer gets what the consumer wants.
Yeah, this is not quite capitalism because the government is willing to do all manner of things to achieve the goal and to make those things cheap. So one example, we wrote a piece many months ago now called Geopolitical Warfare. One of the things the Chinese is willing to do that the Western countries are not is to allow its chosen state-owned enterprise champions to pollute with abandon and destroy their local environment in the name of getting market share. So famously, if we have said, if your competitor's idea of a water treatment plant is a pipeline to the river, it's very difficult to compete with them on price. And in the solar, polysilicon space, they came to dominate the industry because they have lax pollution controls. This is how they came to dominate the processing of rare earth metals and the production of magnesium. There used to be a giant magnesium facility in the Gulf of, in the southern Texas along the Gulf of Mexico. That facility was built in World War II to support the war effort. You need them to make aluminum work in many applications. You need magnesium. And we didn't like the look of that and the environmental impact of it, and the Chinese were willing to monopolize that market, and now they do. And so if your geopolitical competitor is not pricing economic damage fairly, then they will win. So I wouldn't call that capitalism. I would call that cheating. And the Chinese cheat. They steal. They bribe. They blackmail. They do all of those things that are not capitalistic. They have a country objective to dominate an industry, and we as capitalists, without the same level of government intervention and support, or when it arrives, not nearly as effective, can't compete in that way.
Yeah. I've lived in China for a couple of years, and the speed with which they are able to move and make massive decisions is staggering. Obviously, sometimes, that also poses the risk that sometimes you make the wrong decision, right? And democracies are super slow, but that means seldomly you completely screw something up because you just move too slowly, right? On the other hand, Chinese, in the past, they have made a lot of great decisions. Then again, from time to time, you have some decisions that are, terrible, with huge consequences. Looking at, their population demographics, for example, right now. But I broadly agree with your analysis there.
Yeah, it's easy to go fast when you could steal the very best of the top 5 Western producers of whatever you're trying to break into and combine it in a super product that you make at cheap price. So it took decades for GM and Ford and Volkswagen and so on to develop the intellectual property to make the beautiful cars they make now. And they have labor laws, and they treat their employees with safety and good benefits and pensions and so on that the Chinese have no regard for. And so when you take the very best of GM, Ford, and Honda, and Toyota, and Volkswagen and put it into a supermobile without having to spend the time and money to develop that IP in the first place, you can just cheat. Of course, you can go fast. And that's what the Chinese do. They do it all the time. And look, this is talking about the Chinese Communist Party. This is not some inherent feature of the Chinese people. I want to be very clear. I have many friends in China. I too spent a lot of time in China in my career. There's a lot of really brilliant, hardworking, ethical people in China, but the CCP is a criminal organization. And they steal, they bribe, they blackmail, they cheat, and they win. And that's what's going to happen in the automotive sector, and that's what's definitely going to happen in semiconductors, in our view.
Last question. Talked about Germany already a couple of times because we have a lot of German viewers. What is Germany doing? What red flags do you see?
Germany is in need of a political revolution. The fundamental flaw with Germany is this quirk of parliamentary systems that we wrote about in a piece many months ago, how a party with relatively modest representation can become the swing player in a coalition government that requires more than 50% of parliament to stay in power. Famously in Canada, Justin Trudeau is still in power today because of the New Democratic Party. And that party, I think, won a dozen seats outside of the province of British Columbia, and yet it's the Fulcrum Party that is holding up the entire edifice of Canadian liberalism and postponing the election for as long as Trudeau can to hang on to power for as long as he can. The Green Party in Germany, which has never really polled above 15%, holds disproportionate power in the Republic today, executes that power in a way that is very damaging to the German Republic. The predictable populist backlash that is happening in Germany today is the consequence of such decisions. And then the manner in which that backlash is being handled seems to be making the problems worse. And so we have many friends in Germany as well. The German people are amazing. They need better leadership. The sooner they can get better leadership, the better. Also hanging over the entire European experiment is this war between Russia and Ukraine. It would be nice to see that resolved as well, on favorable terms, of course. Perhaps that's wishing for too much. But at the moment, if you ask us to isolate one variable that explains most of the pain that the Germans are experiencing, it is the disproportionate power of the Green Party in the past 15 to 20 years. Power that was granted to it by Angela Merkel, of course, but the consequences of the insane energy policies that the Green Party has been able to impose upon the German people are now beginning to be realized, and the people aren't happy about it, which is understandable because they've been sold a lie. And the consequences of that lie are now just coming home.
Doom, that was incredibly insightful. Where should people go to learn more about you?
They can find everything at Doomberg.com. We've got a new domain name, and we managed to kick a squatter off of it for a small fee. Not so small a fee, but a fee nonetheless. But we're now, everything is under Doomberg.com. Our pieces, our pro tier, our podcast appearances, all of that is listed at Doomberg.com as the main gateway into the Doomberg universe. It was fantastic to be here. First time on your show. I really enjoyed it and hope to be able to come back sometime.
Thank you so much. And don't forget to like and subscribe. Goodbye.